Hi there, welcome to Kneppy Invest. I have a question for you. Can you judge the quality of a company solely by looking at the long-term chart? I am going to test this hypothesis because I've mentioned this quite a few times in my videos before, that you can simply judge the quality of the company just by looking at the long-term chart. But it makes sense to me why that would happen, because a high quality company should grow significantly over time and the share price should respond to that growth. So the share price should be significantly higher today than it was 10 years ago or even 20 years ago. But is that true? Can you judge the quality of the company just by looking at a chart? So what I'm going to do in today's video is I'm going to go through the biggest 20 companies on the ASX by market cap, and I am biased when it comes to my perception of the quality of these companies already without even looking at the chart. And I'm going to see whether it aligns, whether my biases align with what I see in the chart. So I have chosen these top 20 companies or biggest 20 companies on the ASX via market index. They rank all companies on the ASX by market cap. And this changes, I think, every single day. So at the end of trading on Friday, the 24th of January, the 20 biggest companies on the ASX were CBA, Commonwealth Bank of Australia, BHP, CSL, NAB, Westpac, Macquarie Group, ANZ, Wesfarmers, Goodman Group, Fortescue, Woodside Energy, Telstra, Rio Tinto, Aristocrat, Transurban, Wisetech, Woolworths, REA, QBE, and Medicus, companies that just missed. And I could actually expand this to looking at the top 40 companies, but I won't because time constraints. So the next 10 companies that didn't quite get there include Brambles, Xero, Coles Group, Suncorp, ResMed, Santos, James Hardie, IAG, Cochlear, and Fisher and Paykel. So what I'm going to do in this video is just go to TradingView, have a look at the 20-year chart for all these companies, a weekly chart. And the only moving average I've chosen to include is the 200-week moving average. And the reason I've chosen that is because of what Charlie Munger has stated, that he believes if you just bought high-quality companies at the 200-week moving average, you will significantly beat market returns. And the more I look at that sort of assertion, the more I delve deeper into that, I think there is some truth to it. Okay, so let's start off with the biggest company on the ASX, CBA. This is the 20-year chart. Now, to be honest with you, I would probably classify CBA along with the other banks as low quality. But if I had to choose one bank, not including Macquarie, I would choose CBA. I would say Commonwealth Bank might be close to being a high quality, but not quite there because of the lack of revenue growth. I need that revenue growth. Now, looking at the chart over the last 20 years, this is not a bad chart. In fact, the share price of CBA has risen, I think it's grown fourfold. Yeah, back in 2005, the share price of this company was around $40. Now it's $160. Now, in saying that, we have seen the share price rise significantly in the last year. So the share price is well above the 200-week moving average. And that is something else you could do. Just look where the share price is in relation to the moving average. And it's probably the distance between the 200-week moving average and the share price of CBA is probably the highest it's ever been. So if you're looking at standard deviations, that sort of thing, it is overvalued. And we already know that CBA is significantly overvalued right now. Funny enough, if you do look at when the share price falls significantly below the 200-week moving average, you see it do that during tough times, during tough economic times. During the GFC, it fell significantly below the 200-week moving average, and also during COVID-19. Those are the times to buy CBA, in my opinion. And don't forget, banks are cyclical. Now, this is not a bad-looking chart. In fact, if I saw this chart, I would say it's not a bad long-term hold. Maybe not now. I wouldn't definitely not be buying CBA right now because I think it is overvalued. But if you do see the share price pull back significantly, maybe CBA could be a long-term hold. There you go. So this is a bit of a test of my hypothesis around CBA. What about BHP? I would consider BHP to be low quality because it's mining. But if I had to choose a mining company, any mining company in the world, to own for the long term, it probably would be BHP. And I expect the chart for BHP to look not bad over the last 20 years. Definitely a dip in 2016 because that was the bottom of the iron ore cycle. So let's have a look at this chart. And yeah, we definitely see a fairly big dip in 2016, but over time, share price of BHP has risen, but not a lot. In fact, back in 2005, share price was about 16, now it's 39. So just more than doubling. And I'll be honest with you, you really want to see your capital in a company more than double, significantly more than double in a 20-year period. Now, the other thing you'll notice is a lot of times the share price of this company is well below the 200-week moving average, particularly during downturns in the cycle of iron ore 2016. That is the time to buy. So if you have a look at when the share price is significantly below the 200-week moving average, towards the end of 2008, back in 2016, and during the COVID-19 financial panic, those are times to buy or think about buying BHP. Interesting enough, the share price right now is below the 200-week moving average. Is it time to think about buying BHP based off that criteria? Maybe. So I would not be hesitant about buying BHP for the longer term, particularly if I saw the share price significantly below that particular moving average. So I don't consider BHP to be a high-quality company, but I wouldn't be resistant about owning this company for the long term if I see value at a good price. If I see value or the share price at a good price. I think I said that right, maybe. Okay, CSL. This is what I'm going to do. Before I look at the chart, I'm going to tell you my biases. CSL, high quality, without a doubt. High quality, not going to even think about this. And I expect, well, I know what I'm going to expect in the chart. Yeah. So what we're seeing now with CSL is it's going sideways. It's been going sideways for about 5 years. It's basing. It's consolidating. This is, it's going to be great when CSL breaks out. This is a growth company. Really good growth in its revenue, really good growth in its earnings per share. And I think that growth is going to continue. And we can definitely see over the last 20 years, the share price of this company has risen significantly. In fact, 20 years ago, the share price of CSL was about $10. Share price has gone from $10 to $272. So we're talking about BHP almost, or just doubling, just being not tripling, sort of in between doubling and tripling. CBA would quadrupling. CSL share price has risen 27-fold in the last 20 years. That's the sort of returns you want to really see in your portfolio. So even though the share price has gone sideways in the last 5 years, before that, this was an absolutely brilliant investment. So between 2012 and 2017, 2019, 2020, this was a great hold. Absolutely brilliant hold. So CSL, high quality company, and I'm not changing my thoughts just by looking at the chart. The other thing to notice is we have seen the share price get below the 200-week moving average a few times in the past few years. Best time to buy this one in the last year was back in October 2023 when the share price fell below 240. Can't remember why. And right now the share price of CSL is below the 200-week moving average. So if you're not a shareholder of CSL, maybe now is a time to think about buying some shares in this high quality company. I'm just putting it out there. You should make up your own decision. You should be the boss of yourself. Okay, NAB, low quality. In fact, I don't expect the share price of this company to have moved much over the last 20 years. Maybe up a little bit, but this is not a high quality company. Very little growth in revenue, if any at all. And I'm going to say the same thing with the other banks, except Macquarie. So let's have a look at the chart for NAB. Does that ring true? Absolutely. Share price has not moved in the last 20 years. In fact, the share price high for NAB was back in 2007, just before the GFC. This is the chart of a non-high quality company. This is the chart of a low quality company. That's probably the better way to say it. The only time I would even think about buying NAB is when you see value, significant value, when the share price is significantly below the 200-week moving average. So I think there's no questions about this. This is not a high quality company. I'm going to say the same thing about Westpac. By the way, NAB is towards the high of its range. So it's getting to the point where the share price is well above the 200-week moving average. So if anything, it's more of a sell than anything else. What about Westpac? Do we see the same thing here? Almost, probably a little bit better than NAB. The share price of Westpac has increased over the past 20 years, but not a lot. So 20 years ago, share price was about 19. Now it's up to 33. So it hasn't doubled. I'm sure you get a nice little dividend, but is the dividend enough? You want to see capital growth. And again, just like NAB, the time to buy these companies is when you see the share price well below 200-week moving average, where there might be some value. And we did see the share price of Westpac get down to $15 twice during the GFC and during COVID-19. So again, the banks are cyclical. Banks are cyclical. If we have a really significant deep recession, the banks' share prices will drop significantly. And that's the time to think about buying these companies. Okay, so that's Westpac and NAB, definitely not high quality, not surprised to what I see here, and these fit with my hypothesis. Okay, now on to Macquarie. I would say Macquarie, I have looked at Macquarie in the past, and there are some things which make me hesitant to call it a high quality company. But if I was pushed, I probably would say it's on the lower spectrum of the high quality part of that spectrum, whatever you want to say. So I wouldn't say it's really high quality, but I would say I could definitely argue it's high quality. So let's have a look at the chart for Macquarie. Do we see the same things here? And the answer to that is probably yes. A brilliant chart from about 2013. Now, between 2007 and 2013, nah. So again, a bit of a cyclicality there. Our share price was mostly below the 200-week moving average for that 6-year period. But after the breakout in 2013, in fact, the 200-week moving average has been a beautiful trade here. Whenever the share price of Macquarie Bank gets the 200-week moving average, you buy. It's hit it went below it during the COVID-19, but it's hit it once, twice, 3 times during the last 10 years. And that's the time to buy Macquarie Bank. Right now, it's well above the 200-week moving average. So if anything, definitely not a buy at these levels, all-time high as well. So Macquarie Bank, this is sort of what I'm thinking. It's sort of like, yes, maybe it's high quality. By the way, the share price has increased from about, in 2005, it was about $60. Now it's $239. So it's quadrupled in 20 years. That's okay. Not like CSL okay, but it's okay. ANZ, it's going to be like the other two banks, ANZ and Westpac. No, nothing here to see. Yep, nothing here to see. Just take what I said in regards to NAB and Westpac and just apply it to ANZ. So, and by the way, during those cyclical downturns, ANZ got down to $12 and $14. So $12 during the GFC and $14 during the COVID-19 financial panic. And that's sort of the price range you might want to buy ANZ. Wesfarmers. Okay. This is another interesting one where I do believe Wesfarmers to be probably sort of like Macquarie. I think it's maybe a little bit higher than Macquarie in terms of quality. So not the highest quality company, definitely not in the top 20. I'd definitely put CSL well above Wesfarmers and Macquarie, but definitely a better quality company than the banks and CBA and probably BHP. So yeah, definitely a company I would own if I saw some good value, not just now though. So let's have a look at Wesfarmers. Do we see that in the chart? Yeah, we do see that in the chart. Although, in saying that, there was a long period here between 2005 and about 2018 where the share price did nothing. Share price in 2005 was about $25 or $27, and in 2018 was $30. So not much increase over that period of time. So maybe there was a period, maybe the company grew and it was just a period of multiple contraction. Since then, the share price and the chart looks pretty good. Again, when the share price falls below the 200-week moving average, probably a time to buy. Even from 2010 or after GFC, whenever the share price fell below 200-week moving average, it was a good time to buy. It was just not much deviation above the 200-week moving average. Right now, it's well above the 200-week moving average. I think there is a little bit of too much enthusiasm when it comes to Wesfarmers. And if I see the share price of Wesfarmers pull back significantly, I could be a buyer of this particular company, which I do think is a quasi high quality company. Sort of like Macquarie Group. That's what I'm going to say. They're quasi high quality. Goodman Group. Well, I own, by the way, I'll tell you which companies I do own. So I own CSL for the long term and I own Goodman Group for the long term as well. I expect this to be an absolutely brilliant looking chart, except before 2010. So this company definitely had troubles during the GFC, if I remember correctly. So you're going to see a much different chart after 2010. So let's see if that rings true. Yes. Now, I don't know much about the history of Goodman Group, but I do know this company did suffer during that period. And really, this has the hallmarks of a high quality company. So what I'm going to do is just go back, start from 2012. This is a brilliant chart. And this is sort of in line with Charlie Munger's theory that you buy high quality when the share price drops to 200-week moving average. If you did or followed that line of thought when it comes to Goodman Group, you've done really well. So it did drop below 200-week moving average during the COVID-19. Also dropped below during October 2022. Share price dropped to $16, and now it's 38. So it's ringing true here. Beautiful looking chart. Share price has increased from $4 to 38 over the last 13 years, which means it's been a 9-bagger over that period of time. So this is definitely more trending towards high quality. So I'll definitely put this above Wesfarmers and Macquarie Group. Probably the only problem I have with Goodman Group right now is the valuation. And you can see the share price is well above the 200-week moving average. So that's something you've got to be careful. And I think eventually share price will drop, and eventually we'll see another good buying opportunity for Goodman Group. Okay, now on to Fortescue. Fortescue, mining company, hence it's low quality. You will see, you can see periods of time where the share price did nothing. The low in the share price was 2016, the bottom of the iron ore cycle. Share price did fall below $2, very close to $1. Not much here on the chart before that, even after that. Share price broke out in 2019, still remember that. It was just, I'm pretty sure it was just after or around the Vale mining disaster. And also, I'm pretty sure we saw iron ore prices go really high. So the share price of Fortescue will be linked to iron ore prices. You could say, well, this looks pretty good from 2019 onwards, but that's because of iron ore. Before that, looks pretty ugly. But to be honest with you, if you've just held shares in this company for the last 20 years, you've probably done fairly well. Because 20 years ago in 2005, the share price of Fortescue was 26 cents. So you've done fabulously well. Fabulously well. But I can't remember when Fortescue went into production. That's the thing. That this company was not always in production. So that's probably why the share price of this company dropped significantly during the GFC. It was more of a story stock. Anyway, so the chart looks way better than me saying it's a low quality company, but it's just mining. I always consider mining companies to be low quality, but this has been a wonderful wealth winner for shareholders who have held on for the last 20 years. I just don't expect the same sort of returns over the next 20 years because this company is in production. You could also say maybe with the share price below the 200-week moving average, maybe it's a buy. I don't know. Woodside, I know this one. This is going to be a horrible looking chart. By the way, oil prices have done nothing over the last 20 years. And I know some people say to me, Woodside's not really oil, it's more gas. But what we're going to see here, oil prices have done nothing over the last 20 years. Just to confirm that, let's have a look at oil prices. Crude oil. Oh, it's not the right one. I do have a chart here with oil prices going back that far. Let's have a look. This is oil. Over the last 20 years, it's done nothing. Oil has done nothing over 20 years. And let's just go back to the top 20. And what's the company? Woodside. This is going to show the same thing. In fact, there was a nice chart between 2005 and 2008. Share price of this company in 2005 was about $20. Now it's $24. But the high in Woodside was back in 2008 at $68. Share price has fallen from $68 to $24.48. This is the chart of a low-quality company. This is the chart of a low-quality company. In fact, it seems like the share price is staying more below the 200-week moving average and staying above. Anyway, so this is definitely not a long-term hold. More of a trading stock for me. So this fits in with my hypothesis or thoughts or beliefs, biases, that Woodside is not a high-quality company. Telstra, not a high quality, but do we even have to look at the chart? You're going to see a lot of volatility in this company. You're going to see the company go on runs. This is definitely a trading company. Comparing the share price now to 2005, I would not be shocked to see it down. So let's have a look at Telstra. It all depends on which part of the cycle it was in 2005. There it is. Yeah, the share price is lower. So in 2005, the share price of Telstra was about $5, between $4.55. Now it's $3.95. And you can see the share price of Telstra goes on runs. Look at the run. Beautiful trading between 2011 and 2015. Share price of Telstra went from 260 to 660. And then the share price fell all the way back down. So when the share price of Telstra, or if the share price of Telstra falls below $3, that's the time to buy. Again, when the share price is well below the moving average. Anyway, so this is definitely not a long-term hold. I don't care about the dividends. I don't care anything about that. It's capital growth. That's what I'm focusing on here. That is the definition of a high-quality company. And Telstra, I'm sorry, Telstra, you are not a high-quality company. And this confirms my suspicions. It confirmed. So I'm looking for evidence, and this is evidence. Rio Tinto, another iron ore company. It's probably the same, maybe similar to BHP, not as good as Fortescue, definitely, because this company would have been in production in 2005. And yeah, I'd say this is fairly similar to BHP. Let's have a look. Let's compare the two. Yeah, fairly similar. Yeah, they're mining companies. That's what I'm going to say. Rio Tinto share price in 2005, we'll say about $40. It's 118. It's tripled in 20 years. Yeah, it's cyclical. Anyway, that's what I'm going to talk about Rio Tinto. I'm not going to change my opinion on mining companies. Mining companies are low quality. They're price takers. Aristocrat, high quality. Hasn't always been the case. This company actually was struggling before 2011, by the way. I still remember discovering this company in 2012. And it's just before that, it wasn't really doing anything. And this company has seen significant growth in the last 13 years. You'll probably see that in the chart, if I remember correctly. I even remember another company called Ainsworth was probably more favored over Aristocrat before 2011. I have a feeling that might be true. And I'm going to test that as we look at Aristocrat's chart. Okay, so yeah, this company was struggling. So the share price was below the 200-week moving average from 2007 all the way through to 2013. 6 years, the share price was floundering. Share price at the low in 2011. So I have my years out a bit. So 2013. So 2011 share price was as low as $2. Share price now 68. Share price then broke out sometime in 2013-14. And just like Goodman Group, whenever the share price of this company falls below 200 moving average, just buy. And I did buy Aristocrat when it did that. PE ratio was like 16. I was like, I know the ESG issues, but that's not a reason not to buy this company. I would never have that belief that you have to look at ESG. This was just a great investment. I don't gamble myself. I have no reason to gamble. People might say, well, you're investing, you're gambling. No, it's not. It's completely different, in my opinion. So I would say this is a high quality, except would I buy this now? Probably not. Well above the 200-week moving average. So this has room to drop. We saw that back in 2021. Share price got to $48, well above the 200-week moving average, and then dropped. So this definitely has potential to drop, say, from 68 down to, say, 45 or so. The other one was Ainsworth. I think it's AGI. I still think this company was much more thought of. Yeah, so it was 2012, 2013. That's what I'm thinking of. Look at the share price between 2012-13. Share price of this company went from 20 cents to 480. And back then, Ainsworth was preferred over Aristocrat. So times do change and our perceptions of companies do change. Okay, so that's Ainsworth. Go back to weekly chart. I'm not sure why I went to daily chart. Transurban, infrastructure, nah, not high quality. This is not the sort of company I would own for the long term. Sorry, not me. I would expect a nice little uptrend. Nice little uptrend during 2011. This was definitely a hype stock on the ASX. A beautiful uptrend. Another company whose share price is just going sideways. It's going sideways, oscillating above and below the 200-week moving average. I have no desire to own Transurban at all. I don't really care that it's defensive. It has infrastructure. It is inflation proof. I don't care about all that. It's just not a high quality. The revenue growth is not going to be significant enough for me to get excited, put it that way. And by the way, in 2005, the share price was $7. Now it's $13.57. So you haven't seen the share price double in the last 20 years. To me, you want more than doubling in your capital growth. You want quadrupling, what's five? Going up fivefold? You want septupling, that sort of thing. What's fivefold increase? I forget. Anyway, so Transurban, I will never consider high quality, and to me, the chart is not screaming high quality. Wisetech has not been listed for 20 years. Listed 2013-14. Oh, could be out by a few years there. This is a high quality company. In fact, if you compare the share price to the 200-week moving average, maybe it's gone below it once, maybe during the COVID-19. I would not be surprised to see it never drop below the 200-week moving average. Definitely high quality. And yet, we're going to zoom in a little bit. It fell briefly below the 200-week moving average during the COVID-19, very briefly. In fact, the 200-week moving average didn't start until around that time, and this company listed in 2016. So what did I say? So a little bit later than I thought. This is the chart of a high-quality company. It goes up and down. At times, there's a little bit more negative sentiment in this company because Richard White does something or there's a short report, but share price always rebounds. This company is growing, great revenue growth, has all the hallmarks of a high-quality company. When I look at the financials, revenue growth, return equity, all that jazz, margins. So has all the hallmarks of a high-quality company, and the chart backs it up. Backs it up beautifully. Thank you, chart, for Wisetech. But to be honest with you, no surprises there. Next company is Woolworths. I don't care this is high. I don't care this is defensive. I don't care that has a name. I don't care anything about that. I would never classify Woolworths as high quality. Sure, it's defensive. It will never go over to business, but I don't think you're going to get returns out of this that would justify holding it for the long term. I think it's just going to be mediocre returns. That's my thoughts. So I'd never own Woolworths for the long term unless I see some value, which means I need to see the share price drop a lot. So what we're going to see with the chart for Woolworths over the last 20 years is the chart of the share price would have increased. I'm going to say maybe double to triple over the last 20 years. That's about it, which again, I want more than that when it comes to capital growth. So let's have a look at the chart for Woolworths. Okay, let's go back to 2008. Let's go back a bit further, 2005. So 2005 share price of Woolworths was $14. Now it's $29.96. It's doubled. And you can see periods where the share price does flounder. I still remember 2016 when margins were dropping. That was a time to buy Woolworths. Interesting enough, so we did see the share price of Woolworths struggle in 2016. We're starting to see that as well now. Share price is well below the 200-week moving average. So maybe now is the time to think about buying Woolworths just based off the chart and where the share price is compared to that moving average. When the share price gets well above, I would probably be selling. I haven't had a close look at the financials, but I'm not sure if I would be attracted to buy Woolworths at these levels. But I definitely can maybe see why some people might. But again, 20 years, share price of this company is double. I don't care about dividends. Does not matter. You could choose CSL or Woolworths. Which one would you choose? CSL. You should be choosing CSL every day of the week. I did this exercise comparing CSL to Telstra, looking at returns since Telstra IPO'd. So many people would have invested in Telstra because of dividends. And that was the wrong choice back then because CSL, if you invested the same amount of money in CSL, your returns would have been 100-fold different. I think with CSL, you would be a multi-millionaire. You might have $5 million from that investment. If you put the same amount of money in Telstra, you'd have like $200,000. So multi-millionaire compared to $200,000. And that's a problem with being fixated on dividends. So unless you're an income investor, you need the income. There's no reason to be investing in these companies that have high dividend yields because they're not growth. You want growth. And Woolworths is not a growth company. So I would never invest in Woolworths for the long term unless I see some really good value. And by the way, if I invested in Woolworths back in 2016 because it was good value, I would not be owning for long. I would have sold out. I would have sold out eventually. So definitely not a long-term hold. Compared to the next company, REA Group, this is definitely a long-term hold. This is definitely a high-quality company. I expect the chart to be absolutely spectacular for this one. This is probably my longest holding ever. And when I say that, I bought this when I first started investing. I held it for well over 10 years. Then I sold it for a brief period, and then I bought back in. And I'm glad I did that because I actually bought back in a lower price. But this is the definition of a high quality company. This is the sort of company you want to own for the long term. Doesn't mean REA Group right now is a great buy. We'll wait and see. So let's have a look at REA Group, a beautiful looking chart. In fact, you need almost to have a look at the logarithmic chart because the share price has just gone so bananas that you can't even see the start of this period. So back in 2005, the share price of REA Group was below $2. Share price now is 241. We have seen a 100 bagger here. This is the sort of company you want to be owning for the long term. This is why I look for high quality companies. Beautiful growth in revenue, really good margins, really high return on equity. This is a poster child of a high quality company. And this is a beautiful looking chart. So if I had a choice between REA Group, any of the banks, Woolworths, Telstra, Transurban, Woodside, iron ore companies, I'm choosing this sort of company every day of the week for a long-term hold. Anyway, so if we just zoom in, on occasion, the share price does drop below or towards that 200-week moving average, COVID-19, and briefly during the tech sell-off in 2022. And those are the times to buy this company. So I initially bought REA Group well back in 2011, 2012. Brilliant compounder for me. I then sold. I just had a look and I went, oh man, this is really expensive. Up in 2021. And I wasn't really paying attention to how far it was from the 200-week moving average. I sold it somewhere here. I think it was $160. And then I bought back in at about 130, 140. I did not buy at the bottom. I should have been paying more attention. I wish I knew this 200-week moving average then. This would have been a great buy. Anyway, so I did fall well below 200-week moving average. In fact, it fell below $100 for a brief period, and it's more than doubled since then. So this is the chart of a high-quality company. So no surprises here. This is exactly what I expected to see. REA Group, one of the best companies on the ASX. Okay, next one is QBE. Not high quality, but this is a trade for me right now. And the chart looks pretty good. So this is more of a trade. So definitely not high quality. And I think what you're going to see with the chart is a share price high, I would say would be 2007. This company went through a lot of problems for a long period of time, and share price dropped a lot, and now it's rebounding. That's what I expect to see. And let's see if I'm right. Share price high, 2007. There we go. Share price got to a high of $34 from 2008 all the way through to just recently. An ugly looking chart. In fact, that was the definition of a downtrend. Share price, whenever it went above the 200-week moving average, you sold. If you were short selling this, you sold. And then it changed in 2021, 2022. And you can see that. Instead of the share price going above the 200-week moving average and then falling below and staying below, in 2021, 2022, share price went above the 200-week moving average and stayed above and has continued to stay above that average, that moving average, since then. We've seen pullbacks, but this is a nice looking chart. This is a turnaround story at this point in time. And that is why I'm trading it. Not sure how long the turnaround will go for, sort of like AMP, but definitely not the chart of a high quality company. Because that period between 2008 and 2020, just share price went down a lot. And yeah, that's what I'm going to say about QBE. Okay, Pro Medicus, this is a bit of a cheat. We know what the chart's going to look like here. Definitely a high quality company. Overvalued for sure. Overvalued. This is the sort of company where I've been umming and ahhing, less so recently, about whether I should take profits. You definitely need a logarithmic chart for this one. You kind of, yeah. In fact, let's do it. So you can do it, for those who don't know. If you go into this little, I'm not sure what it is, this little symbol down here, you can go from regular to log chart. And this is the log chart for Pro Medicus. Going back to 2005, this company made probably the greatest acquisition in ASX history. I want to do a video on that. Pro Medicus made the greatest acquisition in ASX history in 2009. the exact time to make acquisitions at the bottom of the cycle. That year was a great time. They made the acquisition of Visage, and you have seen the share price absolutely take off because of that acquisition. Funny enough, they made that acquisition in 2009. Share price actually floundered after that. Well, for the next 3 or 4 years, it floundered. I did my first research on this company in 2012-13 alongside Somnomed. Share price of both companies, or the valuation of both companies, was quite similar. Pro Medicus now has a market cap that's probably 1,000 times higher than Somnomed. So both companies have gone in different directions. And this chart is just a wow. It's just a wow chart. I'm going to go back to non-logarithmic and just zoom in. By the way, 2005, the share price of Pro Medicus was around $1. It's now $2.72, so 272 bagger over the last 20 years. Okay, so let's go back to the non-log chart, the normal chart, or regular chart they call it. And let's just zoom in so we get a better, The share price of this company has not been below the 200-week moving average since the breakout, which happened in 2013. So we're talking about 11 and a half years. The share price has not been below the 200-week moving average. Has it tested or got near the 200-week moving average? Oh, there we go. In 2020, during the COVID-19, it did. And I do know a lot of people were buying Pro Medicus at that point. Oh, what a great time to buy Pro Medicus. I did not. It got very close again in June 2022 with the tech sell-off. And I bought Pro Medicus around that time. I can't remember exactly what price, but somewhere there. And right now, the share price is well above the 200-week moving average. This is a dilemma for Pro Medicus shareholders. We know it's really expensive. The company keeps releasing contract wins, and because individually contract win means nothing, but collectively, that's a big deal. And if they keep releasing, I think they released 3 in the last month. If they keep releasing 3 contract wins every single month, this could be undervalued. People have been saying maybe you should take profits. I understand that, and this is one of my biggest holdings right now, and it's a dilemma Pro Medicus shareholders have because, just look at that. The moving average, by the way, is $100. The share price is $2.72. So if the share price falls to $100, I would buy Pro Medicus. Put it that way. Yes, I would buy this company. Okay, so that's Pro Medicus, and that's it. I'll be honest with you. Going through this exercise has not changed my opinion that you can actually judge the quality of the company just by looking at the chart. My opinions have not changed. Now, on some instances, I could be swayed to move in a different direction. CBA is a good case. Looking at CBA's chart actually looks much better than I thought. The other banks, the 4 major banks, they looked as crap as I thought. But all these other companies I would consider low quality. Telstra, Woodside, what else? We have a few there. Woolworths. My opinion has not changed. Definitely not. And the high quality companies, which I've always thought of high quality, not always, Pro Medicus, REA Group, Wisetech, even Aristocrat, Goodman Group. What else is there? CSL. I see exactly what I expected to see. So my thoughts haven't changed, that you can use like a 20-year chart and judge the quality of the company just by looking at that 20-year period. Does that mean the company will remain high quality the next 20 years? Not necessarily so, but I think the odds are in your favor. Okay, that's all I have for this particular video. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.